silver is going to go to 100 or $500, and that's what people are stacking for, is when the system breaks and silver goes ballistic. And so yeah, silver just becomes that play later in the stages. That to me is telling me we're getting closer to a major top in the precious metal space. I still think there's another 40-50% or more for silver to the upside.
You can see the drawdowns are happen more often than the periods. They happen worse than the periods where it is going up. Now that drawdown, if you compare it, gold has more than doubled. Silver has almost tripled.
Silver's explosive move is increasingly being driven by capital rotation rather than speculation alone. After gold led the precious metals complex higher, attention has shifted toward assets offering greater upside leverage. Silver fits that profile perfectly. It is a smaller, thinner market, meaning incremental capital flows can have an outsized impact on prices. As miners, platinum and palladium join the rally, it signals that the broader metals trade is maturing, not weakening. Volatility is rising because silver moves quickly in both directions, often shaking out short-term traders before resuming its rise. Despite sharp pullbacks, the structural trend remains intact, with silver still lagging gold on a long-term basis. That imbalance continues to attract momentum-seeking capital looking for catch-up performance. Chris Vermeulen, a technical market strategist, and Mike Maloney, a longtime precious metals educator, frame this phase as a classic late-cycle acceleration within a larger bull market. Their analysis highlights silver's historical tendency to lag early, then surge aggressively later, often outperforming gold. With gold already having doubled and silver nearly tripling from prior lows, projections ranging from $100 to $500 silver reflect the scale of moves possible in a stressed monetary system. The key takeaway is that volatility does not negate the trend, it confirms it. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The precious metal space, gold has been on fire for a long time. It has been kind of, while silver traded sideways for a year, gold actually just kept moving higher. So gold has had a lot of attention. Enough momentum got into gold that people then eventually bled over into silver. A lot of times I find for major trends, gold moves first and then silver is a little delayed, but then silver will play catch up on the back end, which is what it's doing right now. And so what I think gold got the attention, it got the love, and then suddenly gold's having a pullback and a pause. But now everybody is on high alert that precious metals are a hot sector because we're seeing miners breaking out. We've got silver, platinum, and palladium. Everything is taking part, not just gold. And so I think the reason we see silver moving up is because of simply people want to make more money. Silver moves faster. They're like, okay, well, if precious metals are going higher, give me the fastest moving one you got. Silver happens to be it. Silver also happens to be a much smaller market, I think, than gold. So it doesn't take a whole lot of more money to go into that space to make it go even higher. And so silver is just getting juiced right here because money's moving into it and saying, you know what, forget slow gold right now. I'm going to go into silver. And so silver is getting the attention. And it's, today, I think you and I are speaking, it's down about 4% alone.
Yeah.
But that's typical for silver in this type of environment. We got big up days, up 4 or 5%. Other days it'll be down 3 or 5%. That's just the nature of that beast because it's a tiny market. It moves fast, but it's the favored one right now. People always gravitate to where can you get the most leverage, make the most money. Silver's always been that. That's why there's silver stackers dedicated. Like silver's going to go to 100 or $500, and that's what people are stacking for, is when the system breaks and silver goes ballistic. And so yeah, silver just becomes that play later in the stages. That to me is telling me we're getting closer to a major top in the precious metals space. I still think there's another 40-50% or more for silver to the upside, but it's telling me now people have shifted from boring gold to be more secure. Now they're willing to put on more risk, and that's a little bit of a sign that it's starting to mature, this trade. Silver is fast moving. Fast moving means increased volatility. Increased volatility means more emotional traders involved, right? So when silver's had a big run like it has had here, it's had a beautiful pop and run. It's very quick and easy for it to pull back and to shake people out. And generally what I see is there's usually a 3 to 4 day window. So you have a down day like today, a 4 or 5% down day. And that wreaks havoc and echoes through the people who are holding silver, who are potentially going to sell if it moves down too much. The people who are open to selling because they're worried, they're very short term, they're going to sell. And it usually takes about 3 to 4 days. So silver sells off. Well, there's going to be, the working class. They come home tonight. They come home, they sit down, they look at the markets because they're working all day and they're like, holy crap, silver sold off today. Well, short-term traders already got out today. Like we're talking day traders, momentum traders. But then they're going to see it at night and they're going to be like, well, on Monday, I'm getting out because it looks like it's topped. It does have a little bit of an exhaustion pattern. It ran higher this morning and is closing below yesterday's low, which is not that to me alone is saying we're probably going to see a few more days of downward price. So I think you've nailed that part, David. And then, of course, there's people on the other side of the world that eventually see this move, and then they got to take action for their first day, and then they see it, and the next day, other people get out. So there's different time frames of people, investors who are going to panic out. So I think when we see a sharp move, especially in a volatile asset, it sparks emotions, and then it takes about 3 or 4 days for that fear to finally work itself out. Usually after a big down day, there might be a little bit of a pause or bounce. And that's simply bargain hunters stepping in saying, oh yeah, it sold off way too quick. But usually that overall drip of selling pressure from all the different layers of investors from around the world will carry over and drag it down a little bit more. You're kind of talking about the pair trade. So I'm not a fan of hedging. I used to hedge years and years ago, and I realized hedging costs money. And then a lot of times it's really hard to time the markets. So you put a hedge on and then you realize the asset you were holding and hoping was going to go higher. You put a hedge on to protect it. Your asset keeps going higher and then your hedge just costs you money. So to me, I feel like a pair trade is kind of like a hedge. I'm like, and my other theory is if the precious metal space is going down, if silver is going down, gold's probably going down. If the stock market's going down or say technology, I'm not going to pair it with another sector because I look at the precious metal space as one trade. They generally move up and down together. And same with the stock market. So I stay away from pairing, stay away from hedging. It's just an expense. You're then trying to time some move you think is happening. And I think you're better to just either ride out the volatility and not put the hedges on, or exit it and get back in once you're confirmed that it's starting another uptrend.
And I do want to point out that the Barron's Gold Mining Index is made up of top tier miners. These are, the best. They're the Rolls-Royce, Cadillacs, and Lamborghinis of the industry. I shouldn't have said Cadillac. Cadillac used to be considered a real status symbol in the United States back, when I was young. But if you look here, the first leg up when gold was still illegal for Americans to own, but they could own the stocks, the Barron's Gold Mining Index, the top tier miners did outperform gold. But from then on, it's been a bad bet. Now, I do want to say, I've got a lot of friends, Jeff Clark, Dave Morgan. They write excellent newsletters and they're excellent analysts. And if you pick the right stock, which takes a bunch of research, you can outperform gold. So, or silver, either one. So I always recommend, if you are going to get into the miners, to, Robert Kiyosaki used to say, investing is a team sport. Well, you can make a team simply by subscribing to a few newsletters and seeing what people that actually analyze these mining companies, where you don't have the time to do it. You want to make sure that black line doesn't happen to you. You can see the drawdowns happen more often than the periods. They happen worse than the periods where it is going up. Now that drawdown, if you compare it, I'm going to have you actually go back one chart so that maybe we can see the. Okay, notice that the black area from 2000 to 2007, that part is bigger than the gains in gold. But once gold hit like $1,100 an ounce and it did the pullback to 700, mining index measured in gold, look at that breathtaking drawdown. Now, this is a logarithmic chart. So this is huge. Your losses were huge if you were in the mining stocks. And then when the mining stocks recovered, they barely exceeded their previous high. Look at where gold went. So over time, if you're in gold, if it gains $3 and loses $1 and gains $3 and loses $1, the stocks are gaining $6, but they're losing $5. And then they gain 6 and they lose 5. They're giving you a leverage to gold, but the leverage seems to be greater on the downside than on the upside. And over time, that's what's responsible for the divergence. You've got a greater risk of downside drawdowns if you are in the mining companies. So again, it's fun if you pick the right stocks, and for that you need help. You need to go subscribe to some newsletters.
The longer-term cycle analysis suggests that while precious metals are entering a powerful phase, investors must separate real money from inflated assets. Mining stocks historically deliver explosive upside only in narrow windows, followed by severe drawdowns when measured against real money rather than currency. Dilution, capital raises, and private placements continuously erode shareholder value, making miners structurally inflationary even during bull markets. As global growth slows and confidence weakens, policy tools may delay downturns but cannot stop a complete market reset. Price action remains the most reliable signal, not narratives or central bank promises. Current trends point toward heightened volatility into 2026, with metals likely benefiting first as capital rotates out of overstretched equity markets. In such transitions, gold and silver often surge initially before broader economic stress forces liquidation across all assets. This creates both danger and opportunity for prepared investors. The coming period is defined less by prediction and more by discipline, capital preservation, and flexibility. Understanding where cycles mature allows investors to avoid devastating losses and position for long-term gains once the reset is complete. Let's get back to the interview.
So the big opportunity in mining stocks occurred in 1960, went until about 67 or something?
Yeah.
66? Yeah, that was it. Right. Yeah. That was the big opportunity. Now, when they outperforms, it does way outperform. But if you had invested in 67 right at the peak, you didn't bother to, when you were making this chart, look at, let me see, 1.53, 4.5. So this is a linear chart on the
they both are.
Ratio graph. And if it's linear, 1.51, so this is at about 0.5, right? It drops from 6.5 to 1.5. So it drops to 1/12. So what is that? Like a 93% loss? If you're measuring it in real money, it was a 93% loss. And look at where it's been from 2007, before the financial crisis, to today. The top tier mining companies measured. It doesn't matter if you're up in dollars. You should be measuring things in money, not currency. Real money that stores value over centuries. Now, one of the things about metals miners, gold, silver, whatever, they are some of the biggest inflators on earth. I bought private placements when I bought, and when they're doing a private placement, they create a new stock issue usually. And that dilutes everybody that is already holding shares. And they're always trying to raise capital. And when they do a private placement, you're not buying the stock. When you buy a stock on an exchange, you're buying it from somebody else who already owns it. Your currency does not flow to the company that you're investing in. It flows to another trader, and that's a zero-sum game. When you're doing a private placement, they usually give you a discount to whatever the stock is trading at, and they create brand new shares, and your investment does go directly to the company and helps the company grow. So it's a good thing, but it's also a bad thing for anybody that already owns shares. And these mining companies, explorers, all of the whole sector, they are the greatest inflators on earth, even more so than the Federal Reserve.
Well, there's always a counter to every theory and every strategy and every cycle that something could happen and could play it out. I do believe that when the economy does turn, and we've seen this over and over again, when the stock market and the economy slow down and start to head lower, it doesn't matter what the Fed does. In a lot of cases, they're cutting rates, they're trying to do stuff. When everybody's selling and scared to spend money and they don't want to hire people because business is slowing, they can't stop that train. I don't believe. They don't want it to come to an end. And yes, I think you're right, David. I think they could try to hold it up and maybe delay it even further. Eventually, there's going to be a big market reset, and the momentum worldwide will be so big. One country is not going to stop it when everybody just tightens up and they're like, I don't know what to do. Like, I don't want to spend money. I don't want to expand. I don't want to do this or do that. And a lot of people will start to sell stuff. So, I mean, we just have to follow price. I think 2026 is going to be a very exciting year. I think it's going to be huge for precious metals. I think there's huge upside potential in the next month or two still for metals to go much higher. I also think the equities markets are going to go into some crazy turmoil. But if the Fed does juice things up, well, they might push the stock market higher with precious metals still for another year. We just don't know. And that's why it's better to follow trends than try to predict cycles or what the Fed is doing and stuff like that. Just follow price. That's the key. Play. Long story short, there's 3 levels and layers to this. This top layer is like maximum peaks. So for example, in 1999, there was a major cycle peak plus a minor cycle peak, which we led into the tech bubble. 2007 or 2008 financial crisis was a minor peak. And then we struggled with 2019. There was a double peak, which was COVID. There was another type of panic in the market that created a sell-off. The next cycle high is this coming year, 2026. And all the analysis that I've always shared with you, David, has been saying like something big is coming, something bad is coming. The thing is, we don't know when. The markets can drag things out much longer than you anticipate. The key is to make sure you've got a game plan. This cycle is saying we could have weakness at some point in 2026. Maybe it drags over to 2027. Maybe the markets still hold up next year with some QE. I'm not sure. But you need to be prepared, because when this does happen, we could see a weakness all the way down to 2032. So that's a long ways away. It's a long time to be losing money, having businesses downturn. But this is all an opportunity. When the markets do correct, 2032, or when my analysis shows that the markets are turning and things are starting to strengthen, man, if you can survive a market crash and a reset and you have your capital, and you can invest it in ways that will make you wealthier so fast than anything else. You can just move into multiple things. So that's what this cycle plays into. It's a very big analysis. It's not always accurate. It hasn't nailed everything. It's just interesting because it falls in line with the most recent cycles that we've experienced as traders and investors. And the next one happens to be starting in 18 days from now. That year starts. The timer is going for this cycle to find a top in the coming year. You got to follow things on multiple time frames. I mean, we can go and look at a long-term investing chart here of the weekly chart of the S&P 500. And so if we go back to as far as this chart loads, this type of analysis tells us, when we're finding a major bear market top, when there's a new bull market starting, and it gives us these windows where these kind of colored arrows are of when to be protective of ourselves, because you just never know when one of these big resets are coming. So we'll be looking at the weekly chart, the long-term investment signal, saying, okay, are we coming into a 2007 market top? Do we have the divergences? Do we have price starting to break down? All of this stuff. And so it's hard to identify a major bear market, because the reality is you don't know, for example, that this is a full-on bear market until it really has a 20+% drop, and then it finds stability, and then it breaks down from there, and then goes into like the 30, 40, 50+% correction. So that's what we need to see. Like, for example, if we look at 2022, the stock market pulled back 20+%, and then it kind of went into this consolidation. Now, if this broke down and broke this low, then we would probably be starting a massive bear market, a multi-year bear market. But it ended up carving out a bottom. It ended up generating a new strong trend to the upside. and we're back into a trend. So for us to know when we're going to have to see like price break down and have a correction, and then eventually kind of break another significant low. And then from there, it can go into a big waterfall. So we're going to have to look at it from different time frames. We'll probably see the stock market sell off in a big way. And we'll probably see precious metals initially have a very big rally and move higher. And you and I have covered this before, the comparison chart of 2007. And if you take a look at the chart on the left here, the stock market was trading at all-time highs. Gold was pushing to all-time highs. It's right where we are right now in real time. Similar type of setup. Both stocks and metals rallied together for the last couple of years. What I'm looking for eventually is the stock market to break down, and the money is going to come out of the stock market and it's going to shoot and get pushed into the precious metal space. So when we see this, David, when we see stocks crash and all that money comes out of stocks and people push it into the precious metal space, where gold could rally another 15 to 20% from here, silver could rally another 50 to 60% from here, same with platinum, same with palladium, that to me is going to be like, okay, now it is like this feels like the end. The music has stopped for the stock market. And eventually the stock market will put in some type of pause. And then when it breaks those lows, that's when we go into like a stage 4 decline and the bottom falls out and there's mass devastation for businesses and bankruptcies, and gold will pull back with that. So that's what I'm looking for, is this extreme divergence where metals shoot higher, everybody loves it, and people start moving out of gold. That to me will be like one of the last indicators saying, hey, we only have a couple months left and we could be entering a big reset and a recession in the economy, global economy.
This phase of the cycle highlights a clear shift from speculation toward capital protection and real value. The signals coming from metals, miners, and broader markets suggest that volatility is no longer a temporary feature, but a defining condition of what lies ahead. Price action is increasingly reflecting stress beneath the surface, even as headline indices remain elevated. In these environments, discipline matters more than excitement, and issues of patience more than prediction. Precious metals tend to reward those who position early and stay rational when momentum accelerates. What follows major cycle peaks is rarely orderly, but history shows that prepared investors emerge stronger on the other side. Staying focused on trends, risk management, and real purchasing power is essential as markets transition into the next phase. This is not about chasing headlines, but about understanding structure, timing, and probability. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.